Bloomberg Audio Studios. Podcasts, radio, news.
I feel like we should address why we were off air for 3 weeks. People asked me about it.
Oh, really? No one asked me about it.
Well,
no one asked me about it. Why were you off air?
I got
for 3
questions. Well, you had a vacation, then I had a vacation. Then we actually had an episode.
We recorded, I think everyone in this room would agree, the greatest episode of the Money Stuff podcast in its history. Except when I say we recorded it, I mean we performed, but we accidentally did not record.
Yeah, so it'll never see the light of day.
We do, I believe, have your side of the audio, which, like, I was joking we should do like a Space Ghost Coast to Coast thing where, like, we play your audio and I just say non sequiturs that set you up to say something weird in between your audio. But who has time for that?
I was also thinking like Mystery Science Theater where like I say something and then you offer a snippy little comment and then I say something else and you just respond.
There were a lot of ways we could go with that audio.
Who has the time?
Yeah, who has the time?
Not us. No, so we apologize, dear listeners.
You're fine.
I'm sure we all had a great couple of weeks.
Yeah.
You know?
Everyone, we got a vacation from this, they got a vacation from us.
Yeah.
It's fine. I'm going away in a couple of weeks. So.
I'm going to a conference and you're going to a conference.
I want to say this. I'm going to the Tulane M&A conference, which is like the big M&A conference for like M&A bankers to some extent, but lawyers to a very large extent. So if you're there, say hi.
And
I've never been to this conference, but everyone says it's fun because it's in New Orleans. And,
that does sound really fun.
It's a bunch of M&A lawyers.
And the weather should be nice, but not horrible in March in New Orleans.
Whatever.
I'm going to Vegas for an ETF conference.
Sure.
I hate Vegas, but I'll be there. So if you're there, shout out the pod.
Hello, and welcome to the Money Stuff Podcast, your weekly podcast, your occasional podcast, where we talk about stuff related to money. I'm Matt Levine, and I wrote the Money Stuff column for Bloomberg Opinion.
And I'm Katie Greifeld, a reporter for Bloomberg News and an anchor for Bloomberg Television.
Where should we start, Katie?
We could start with Warner Brothers. That happened last week.
It's still happening, but yeah.
It's still happening, but I was on vacation and I left for vacation thinking that, okay, Netflix has kind of got this in the bag. Like they've kind of had this in the bag and they did not have it in the bag. They ended up walking away.
Yeah, it's fascinating, right? Like Paramount had bid $30 to buy Warner Brothers. Mm-hmm. Warner Brothers had said, we'd rather take this Netflix bid, which is like more complicated, but whatever. It was like worth more than $30, right? To Warner, they thought. And then Paramount kept pestering them. And then they eventually raised their bid from 30 to 31. And Warner was like, well, 31 is better than Netflix's bid, although 30 was not. So they went back to Netflix and they said, you have matching rights. Would you like to raise your bid above 31? And Netflix said, no, thank you. See you later.
Yeah.
And so Netflix just dropped out and Paramount is buying Warner for $31.
I could see a world in which Paramount does go after Netflix next because this was pretty audacious.
So you have this dynamic where Paramount thinks that it should be combined with Warner Brothers. And Warner Brothers kind of thinks it should be combined with someone, right? Like Warner Brothers wants to sell itself. And so Paramount, which has a young, ambitious, arguably Nepo baby CEO.
I was going to say a CEO with a deep-pocketed father.
Yeah, a CEO with, let's say, something to prove.
Mm-hmm.
He's like, I want to buy Warner. And Warner has a CEO who has kind of proven himself and, wants to sell, right? And so it makes sense to combine these two companies. I mean, it probably makes sense. They think it makes sense. There's some synergies, whatever. Right? It makes sense to combine the companies. And it makes sense for Paramount's executive team to control the combined company, let's say, right? But what doesn't make sense from a corporate finance perspective is Paramount, which is teeny, buying Warner, which is big.
Yes.
Like in a sort of straightforward world, you'd be like, well, Warner will buy Paramount and then they'll combine them. And then, but it just didn't work out that way because of the dynamics of how Warner is trying to sell itself and bidding against Netflix. And Paramount had offered an all-stock deal, like it would not have worked, right?
Yeah.
So they offered an all-cash deal, which meant borrowing gajillions of dollars.
More than twice their market capitalization, actually, which is pretty fantastic.
Sort of. Depends on how you count. Like their market cap right now, Paramount's market cap is like $13-14 billion, their equity market cap. And the debt for this deal, I think including like everything, is like $79 billion. So it's like 6 times their market cap. But that math is not quite right because like their market cap today is like $13 billion, but they're getting like a 40-something billion dollar equity check from Larry Ellison.
Fair.
They're also doing a rights offering, which I love.
Explain that. And why do you love it?
Well, I love it because it just doesn't make sense for like this teeny company to borrow so much money to buy this bigger company. You do it the reverse, right? And the rights offering is a way to like very slightly move in the correct direction, which is like, we should have more stock outstanding if we're going to swallow this giant company. And so they're offering to sell about $3 billion of stock to whoever wants it, public investors, on the same terms that Larry Ellison is buying. So Paramount is essentially a controlled company, like in the personal ownership of like the Ellison family, but it has public shareholders and they can put in some more money. Basically, if you're a public shareholder, you have the right to buy some stock at the $16 that Larry Ellison is paying.
I mean,
which, like, you know, it's $3 billion of stock, which it's $3 billion less of debt load than you'd otherwise need. And like, they have a lot of debt.
They do have a lot of debt to the point where they were downgraded to junk by Fitch in the aftermath of this, which I guess isn't that surprising when we're talking about some of these levels.
Not at all. I was thinking about like when they were trying to get this deal. So there's a long time where Paramount was pestering Warner to take their deal instead of Netflix, and Warner was saying no. And it was hard for them to say no because a lot of shareholders wanted the certainty and cash of the Paramount deal. And so the board had to defend their deal. And one thing the board said was the Paramount deal would be the largest leveraged buyout ever. And we have doubts that they can get it done. And like, in some sense, that's like a weird thing to say because the Warner board represents the Warner shareholders. They have a fiduciary duty at this point to get the best price for the Warner shareholders. And if you say, well, the Paramount deal involves borrowing a lot of money. It would be hard to pay down all that debt. Like, that doesn't matter. Like, that's not your problem, right? The shareholders are cashed out at that point. If it runs into trouble after the LBO, like, that's not the shareholders' problem. So it's not the board's problem. And the board is defending this as saying, well, we don't think they could even raise the financing to do this LBO, which is kind of a weird thing to think because it's like Larry Ellison and like Apollo. It's like, it's people who can raise the financing.
Yeah.
But now that they've signed the Paramount deal, I'm like, oh yeah, this is the largest LBO ever. And like, I can see why someone with ties to Warner Brothers would be nervous about that. There's going to be a lot of job cuts. There's going to be probably a lot of cuts in production, although there's debate about that. But like, to service all of this debt, it's going to be difficult and it's going to lead to like hard business choices at Paramount and Warner. And if you sold to Netflix, which has plenty of money, you wouldn't have those pressures. You might have other pressures, right? Like, Netflix is not, not necessarily a lavish, benign overload for movie companies, but like having that much debt like makes it harder to run the business. Yeah.
I mean, there were questions about theatrical releases, et cetera, when it came to the Netflix bid.
Netflix is like, you can have your theory of mind of Netflix, but they have plenty of money.
Yeah. Yeah. It's funny. I mean, taking a look at our reporting, both Ted Sarandos and David Ellison had spent a lot of time in DC sort of pitching for this deal. And it seems like one of the factors, though, was the idea that when it came to the regulatory side of things, that it would be a quicker experience going with the Paramount bid than with Netflix that probably would have lasted well into 2027.
A lot of people think that.
Yeah.
Paramount definitely pushed that narrative. Ted Sarandos was going around saying, no, it's fine. We have no problem. We would have got approved quickly. So I don't know the answer. But like, yes, certainly people were nervous about the Netflix regulatory approval process. And this is on the backdrop of everything is about Donald Trump's personal whim. And but anyway, so like there's a sense that like Netflix is politically on the outs and Paramount is politically on the in. But Netflix very consistently said, no, it's no problem. We're fine. We're doing great. So I don't know.
Yeah, I mean, Netflix in walking away said that this was solely about price, that they were confident they could get it.
Which is fascinating. That you've come this far. You've spent this much time and money on this deal. And they're like, could you pay $1 more? And you're like, no. It's amazing. It's an amazing display of discipline. Now, by the way, it's $1 more, but it's also they get a big breakup fee for walking away. So
which Paramount is paying.
There's been a lot of talk about Paramount agreeing to pay that breakup fee. And like, I have always found that talk very perplexing because obviously if you bid $31 per share in cash to buy a company, the incidence of the breakup fee is on you. Like, nobody could possibly pay it other than Paramount. And it's just like sort of smoke and mirrors that Warner was like, oh, they have to pay the breakup fee. But anyway, they're paying it. Fine.
Yeah. Well, also, just to the point on the DC relationship, apparently President Trump told Sarandos at some visit not to overpay for the company. So apparently he took his advice. I don't know.
Yeah, no, he was going to overpay, and then Donald Trump gave him some business advice. He's like, never mind.
If the president tells you that, I mean, kind of feels like the writing's on the wall. Like this is.
I don't think so. I don't think that's like if you overpay, we won't approve it. I think that's just I used to be in business.
Yeah. Maybe.
I don't think it's.
I mean, I wasn't actually in the room, so I don't know. I wasn't either. Yeah.
We're speculating a little bit about what that conversation sounded
I don't know
like.
what room it was. Was it the Oval Office? It could be any room.
Could be any room.
Yeah, perhaps a ballroom. Just from a human level, I mean, just reading this, I feel like I was getting my feelings hurt. Like the fact that it took so many months, Paramount was rebuffed at so many turns. It feels like Warner Brothers, the board really didn't want to do this and then found themselves in a position where they sort of couldn't say no. I feel like if I was in Paramount shoes, I would just feel really bad all the time. But
interesting. I don't know. I mean,
maybe I just don't have the bullheaded confidence, you know?
Warner would never say, we really don't want to sell to Paramount, right? I mean, they're a board of competent directors. They have a fiduciary duty to get the best price for their shareholders. I think that they liked the Netflix deal for whatever reason. They liked the Netflix deal. You know, they'll tell you deal certainty and the value of the cable stub and whatever. But there was always some price. I mean, there had to have always been some price that Paramount could pay that would be enough for them. And it turned out that price was $1 more, which is funny. The other thing that happened that is so strange is that Netflix, you know, was like, we'll pay the complicated package they would pay, and this is our best and final offer. And Paramount said, we offer $30, and it is not our best and final offer. And so it would, like, Warner could not accept that deal. It would be just absolute malpractice to be like, we'll take your not best offer. So they had to hold out for something more. And everything else is in the background of like, oh, we had to hold out for more. And like, I don't know if they explicitly said 31 is our best and final offer, but like 31 was enough.
Yeah. Well, it'll be interesting to see how long this actually does take to get through.
The other thing is, well, I don't think it'll take long to get through. I think they've already gotten some of their clearances.
Yeah.
Although there's like European regulators, a lot can still happen. But the other interesting thing is like, if your model of this is they have taken on crippling debt and won't be able to service it, like you read some people being like, Netflix's plan here is to buy the whole thing in 3 years when it falls apart. Right?
There you go.
Which is one way to put it. Private credit has been a thing. Huh?
Oh my gosh.
Oh my gosh.
It is just
BCRED,
been,
OBDC, all these things.
Yeah. BCRED, Blackstone, stepping up to meet these redemptions personally.
Yeah. Right. BCRED.
Yeah.
The Blackstone non-traded private credit business development company. That's not its name. That's just what it is.
Yeah.
Its name is BCRED. All these non-traded BDCs, they call them like semi-liquid vehicles. Every quarter, they offer to redeem up to 5% of the stock. So they do a tender offer. So if you are invested in this fund, you can't sell it on the stock exchange. There's no way to get liquidity except every quarter they will buy back your shares if you want out, but only up to 5%. So last quarter, they got 7.9% of the fund in redemption requests, which is a record, as we reported. And so they had to scrape to do those redemptions. Not because they didn't have the money. They have like bank credit facilities they can do the money, but because like the way the tender offer works, they can't. It's boring. But like they couldn't actually meet all those redemptions. And rather than say no, which is not quite the same thing as gating the fund, in air quotes, but like, it like look like gating and people get mad and upset. So rather than say no to anyone wanted out, they let everyone get out. And to do that, they paid about 7% of them out with BCRED's money, and they paid the remaining 0.9% out with money from Blackstone, the firm, and from the personal accounts of some Blackstone employees.
Yeah.
Who, you know, get into the fund at it's like meant to be a show of confidence. It's like, we will cash you out at par and we will pay par with our own money because we really believe in these credits.
Specifically, it was more than 25 senior leaders from across Blackstone who reported. Yeah, I've heard that too. I was talking to someone about this on Bloomberg TV yesterday, and they were like, I take this as a very bullish sign. It's akin to share buybacks or insider buying or something like that.
Yeah.
So that's
obviously what it's meant to be.
That's the optimistic angle.
Right.
But the headlines keep coming. And
I mean, like, the angle is like, some retail investors in this private fund, having read bad headlines, wanted to take their money out. And there are offsetting inflows from experienced private credit professionals who work at Blackstone and know the portfolio, right? Like, that's a good story.
But how do
the
you
bad
say
story is
no?
like, you had to twist the arms of the employees to, how do you say no? Exactly.
That's what I would love to know. Like, okay, more than 25 or about 25 said yes. Did anyone say no? Did anyone feel like they could? I want to talk to that person.
The other thing that bothered me about this is like, if you came to me and I was like a sharp-elbowed private credit professional, and you were like,
I can see it.
You were like, all of our retail, not all, 7.9% of our retail investors are panicking and want out of our lovely fund, which has great credits and we totally believe in the portfolio. Would you like in? I would be like, sure, that sounds like a fire sale. I'd be happy to get in when these people are panicking. And then my bosses would be like, great, you're buying at 100 cents on the dollar. I'd be like, no, that's not
good news and bad news.
Like, I don't want to, like, if I think they're worth 100 cents on the dollar and everyone's panicking, I want to buy at 90 because I should get a discount. You know, you think about like the professionals at the firm using their own money to buy the controversial assets. The classic story is in like, I don't know, like 2011 or something. Sometime shortly after the financial crisis, Credit Suisse had this like giant pile of what people called the toxic assets, like the mortgage derivatives and just weird stuff from the crisis. And they were like, we can't sell this. It has a huge capital hit. So we're going to package it into a box and give shares of the box to our like managing directors. And so they've just paid bonuses one year in toxic assets.
Love it.
And like those people all got rich.
Yeah.
Like they like immediately recovered and they did so well because like they got these toxic assets at the marks they were at, which was a distressed mark. But here, everything's at par, you know.
Yeah.
There's no distressed marks. You're getting a price that does not reflect necessarily the level of nervousness that your retail investors are showing when they try to redeem.
Yeah. And that's the thing. I mean, we heard from Blackstone's global head of private credit strategies at Bloomberg Invest this week saying that the noise that you're seeing doesn't match the solid credit fundamentals of the fund's assets. It almost feels like the conversation has sort of moved to beyond that when it comes to the redemption requests that you're seeing. And even if it's not headlines about Blackstone specifically, there's a lot of stories. I mean, there was one on Thursday about BlackRock, marking a private loan they had made to zero.
There's going to be some markdowns on some loans.
Yeah.
I don't know that it'll be universal across all these funds, but like all these people, all these like senior private credit people are going around expressing confidence in their portfolios, which one might be true, and two, they have to say, right? They have to do that. But then like, there's the separate question of if everyone is panicking and you are confident in the portfolio, like, yeah, you should step in and buy. But it's weird to have to buy at 100 cents on the dollar. It's like upsetting. And this is why I love the trade that Boaz Weinstein is doing.
The Boaz Weinstein of it all.
So we're recording this on Thursday. He announced one, I think today or yesterday, for the Starwood private REIT.
Yeah.
And 2 weeks ago, he announced one for these Blue Owl private BDCs, where basically he's going around tendering to buy shares of these non-traded semi-liquid vehicles that people are nervous about. And he's offering to buy them at like, 75 cents on the dollar. Presumably he's more skeptical than like Blackstone is, but like less skeptical than these retail investors, right? He thinks these credits are fine, or he's hedging the credit, I don't know. But like he's getting these credits at a discount because retail investors are, I don't want to say panicking, but they're nervous.
Well, that's what I wanted to ask you was, what is the trade here for Boaz?
The trade is like the value of liquidity in these vehicles has gone up enormously in the last month. People now want this liquidity. And if people really want liquidity, they should pay for liquidity. And Boaz will be the one to get paid.
Yeah.
In theory. Now,
but I'm wondering, like,
maybe no one will tender. Like, this might just be trolling, right?
Yeah.
Nothing forces anyone to tender. And because these vehicles all have mechanisms to cash you out at 100 cents on the dollar, like, not perfect, there's gates, whatever. But because, like, you sort of expect to get cashed out at 100 cents on a dollar, you might not want to tender to Boaz at 75, but you might.
Yeah. To the point he could be trolling. I was looking at some of his tweets, including the one he announced this, and someone commented something like, "You're hilarious, man."
Right.
It is pretty funny.
It's a funny trade.
Yeah.
It's a funny trade because like there's all these headlines about, private credit liquidity. And then like there's all these private credit people going around on TV being like, it's fine, our portfolios are great. And then Boaz is like, I'll pay 75. Like, it's great. It's a good trade.
Well, I was wondering,
it's like a little bit pouring fuel on the fire.
Like how it works out for him. Like, is he...
He might get 0 shares. I don't know. But
I mean, it would be nice to ask the man himself. But like, is this him calling the bottom? And hoping like how it's being traded in the market that it will go back to 100 cents? Or is he just hoping that he will get cashed out at 100 cents?
There could be all sorts of trades.
Yeah.
Like, he could be short the credits, right? But like,
yeah.
To me, like the obvious trade is like the illiquidity premium of these funds has gone way up and he can capture that.
Yeah. Well, Boaz, come on the podcast. Just the point I wanted to make when it comes to like the fundamentals almost not mattering. I do just wonder about the psychological aspect of it all. The fact that over the past several years, all these private credit folks have been pushing so hard into the retail market. Whether this experience overall, even if the fundamentals are fine, will just dent demand going forward from retail.
My bet is always on people having short memories. But like right now, it's like no one's like, oh, we really need to do our retail private credit push, right? Like not this week.
Not this week. I don't know. There's a lot planned. There's like a lot of like interval fund type things that are supposed to push out in the next couple months. So
yeah, we'll see.
We'll see.
We'll see.
Speaking of private assets.
Oh, you want to talk about XOVR?
Let's talk about what's going on in the ETF space. Why not?
From the semi-liquid problems. Totally.
While we're here. So we're talking specifically about private companies because there's this fascinating ETF. The government name is the ER-Shares Private Public Crossover ETF. It's XOVR, XOVR.
XOVR.
It owns SpaceX.
Sure.
Not outright, but through a special purpose vehicle.
Sure.
And the SEC has a cap on how much of an ETF any open-ended fund can have in a liquid asset. It's 15%. The problem that this ETF keeps running into is that it keeps getting outflows. So its stake as a percentage of the portfolio keeps going up. It hit like 44% or somewhere close to it in the past couple weeks.
Also, SpaceX's valuation is like quintupled in the last few years. But
yeah.
Sure.
Morningstar has been very vocal on this, specifically this man named Jeffrey Patak. I hope I'm saying his last name right. That if you take a look at the performance of the ETF, it doesn't necessarily reflect the fact that SpaceX's valuation has quintupled, which is also a big question mark.
Right. This is like the opposite of private credit. Like private credit, everyone's like, oh, the marks are fine. Everyone's like, I don't know about these marks. And then this one,
yeah,
everyone's like, those marks should be much higher.
Yeah.
Which is weird to me that people wouldn't. Usually people mark things up.
Yeah, well, that's the big question there. Like, why? Like, you would think that this fund is absolutely crushing it. But Morningstar has made the case that if you take a look at the performance of this ETF, its performance can be almost entirely explained by its public holdings rather than its SpaceX holdings, which, again, it's a question mark.
What's the question?
Why is that happening?
Sure.
That's the big one.
I mean, the answer, I don't know the answer.
I don't know the answer either.
They've looked in the SPV and the shares aren't there and like, oops, and they close it and forget about it.
Well, that's one of the theories, right? Is that the SPV, that's like a very pessimistic.
The SPV charges 100% performance fee. And so.
Well, it could partly be explained by SPV costs.
Sure.
There was a filing this week where the firm said that in the prior period, the fund's like total expense ratio was 1.18%, even though the management fee is only 75 basis points. And they said that they've since switched to an SPV that has no management fee and no carried interest. So this isn't going to be a problem anymore. So it's going to be interesting to see how that shakes out. But what we do know is that you take a look at this share of SpaceX that is this portfolio, and it is wildly above the SEC's limit on how much you can actually hold in liquid securities. So the point being, this is a story that's developing right now, and it's going to be interesting to see how it shakes out. And it sort of puts the whole push on putting private assets, or at least private companies, in an open-ended vehicle, kind of takes the shine off, because with an ETF, you can take your money out at any time. These funds, ETFs, aren't gated, and that can cause your portfolio to do really funky things if you have to sell your liquid assets. And it's not as easy to sell in SPV.
I mean, counterpoint, it's SpaceX.
Yeah.
Right? This is not a very good counterpoint, right? Because like 3 months ago, everyone wanted to be in credit, now they don't. But like It is a counterpoint, which is that like, people are like, ooh, I'm surprised they're having outflows because people like want to own SpaceX. And if their performance reflected their SpaceX shares, people would want that.
Flows follow performance.
Yeah.
This is probably more a conversation around like SPVs because there is an ETF that does hold SpaceX outright. The ticker is RONB. It's the Barron First Principles ETF. But they've also classified their SpaceX holdings not as illiquid, but as less liquid, which is something that I didn't actually really appreciate until I started looking into the RONB ETF, that you, as the portfolio manager, classify the liquidity of your holdings to the SEC rather than the other way around.
Right. And by the way, like, obviously there are incentives to gain that, but like, I kind of see why someone would say, SpaceX is kind of liquid, right? Like, it kind of trades. It's a $2 trillion company or whatever. Like it's
theoretically going public in the next couple of months.
Yeah, but like also there's secondary trading in that stock now, and there's bajillions of SPVs. Like if you were like gun to your head, you have to liquidate your SpaceX shares in a week. Like you could do it at like today's prices. You could. Yeah. For hundreds of millions of dollars of size, right? Not for tens of billions of dollars. So I don't know. I don't have that like. I keep saying private markets are the new public markets, right? Like there's a continuum of liquidity, and like SpaceX is more liquid than a lot of public stocks.
Yeah. Well, it's interesting. I mean, as far as I can tell, this ETF hasn't liquidated any of its SpaceX SPV holdings.
Right. Also, why would it?
Yeah.
Like, it's a marketing matter.
Well, probably to get below the 15%.
Yeah, sure, fair. But once you solve that problem by saying it's liquid, then as a marketing matter, it's probably better to be like, hey, I'm an ETF that's full of SpaceX than to be like, hey, I'm an ETF with a little bit of SpaceX and other stuff.
Barron, for example, is somewhat of a special case. People familiar with the matter have run this plan by the SEC. Part of their reported logic in why they classified it this way is that they've been investing in SpaceX since 2017, and they have like an established and good relationship with the company that it seems like they would have an easier time getting their hands on more SpaceX than maybe other firms and funds out there. I don't know, like, if any issuer could go to the SEC and be like, actually, this private company, we think it's less liquid. It's not illiquid.
I don't know. I could sell SpaceX shares. It doesn't seem like a big problem. The other thing that I think is interesting in these funds is I just said, like, you'd rather be like, hey, this is an ETF with SpaceX than cats and dogs in SpaceX.
Yeah.
Like, there's obviously a demand for a publicly traded SpaceX proxy, despite how liquid SpaceX is, right? And one thing I've heard is that people talk about these ETFs as like a trade where the trade is you buy the ETF and like with XOVR, there's like they have like a sort of indexy mechanistic like list of their other public stocks. You buy the ETF, you short the other public stocks, and what you're left with is a trade that's just long ETF, short public stocks in the ETF, so you're left with just long SpaceX. And I think that that's like kind of a marketed trade of like, this is how you get your SpaceX exposure. You buy this ETF and you hedge out the public stocks, which reminds me a little bit of the trades we talked about with ARK, with Cathie Wood's ARK ETFs, where those ETFs looked like they might get allocations in hot IPOs. And so people would heartbeat into the ETFs to get
some brave folks.
Yeah. But this is like a sort of, way to isolate SpaceX exposure, if that's the sort of thing you're looking for, which I feel like a lot of public market investors are.
Yeah, perhaps. This fund did run up quite a bit. I mean, it grew to like $1.8 billion in assets at one point, and I have to imagine that was entirely because it was marketed as having SpaceX exposure, but it's since seen pretty significant outflows.
Yeah, I guess if it doesn't go up a lot with SpaceX shares, then it's not a very good SpaceX proxy. And that was the Money Stuff Podcast. I'm Matt Levine.
And I'm Katie Greifeld.
You can find my work by subscribing to the Money Stuff newsletter on Bloomberg.com.
And you can find me on Bloomberg TV every day on The Close between 3 and 5 p.m. Eastern.
We'd love to hear from you. You can send an email to moneypod@bloomberg.net. Ask us a question, and we might answer it on the air.
You can also subscribe to our show wherever you're listening right now and leave us a review. It helps more people find the show.
The Money Stuff Podcast is produced by Moses Andam and Alexis Hott.
Our theme music was composed by Blake Maples.
Amy Keene is our executive producer. Thanks for listening to the Money Stuff Podcast. We'll be back next week with more stuff.